Hello, buddy. Welcome to the TraderMerlin Show. It is your Wednesday edition. Happy Hump Day, everybody. And yes, as I can see, Larry out there saying, big snowstorm coming to Colorado this week. And yes, they're saying it's going to be a monster one out there, so be careful. Of course, we've got a bunch of storms on the horizon, whether you're talking about the weather or you're talking about financial markets. As you guys might recall, we had Stephen Van Meter on the program the other day talking about this huge melt-up, this short squeeze going to happen in the bond market, and that means that yields would just plummet. You know, do we see sub-zero negative interest rates? Well, that was all a hypothesis, and certainly grounded in some very good information from Mr. Van Meter, but we'll talk to other people out there and get perspectives on, is that potentially possible? Are we going to see a bond melt-up? And more importantly, what happened today? Because we've got a 10-year bond auction today. We have the 30-year bond auction tomorrow. So I decided to title today's show Bond Auction Madness. I need to do it with a more dramatic voice. Bond Auction Madness with Bill Addiss. He's our guest today, joining us from an undisclosed location, a bunker on the East Coast. We've got Mr. Bill Addiss joining us. Bill, how you doing?
I'm doing great, Merlin. How are you?
I am fantastic. Any better, I'd be twins. I just wish that we could all just go back to eating out at restaurants and partying and having a good life. But we'll get there slowly. Other than that, I'm great.
That's great.
All right. You, without being bashful at all, claim to be an absolute geek and nerd when it comes to bond markets. And I love it because I'm a geek when it comes to many things. Love getting your feedback on what I mentioned at the very beginning. And I talked to you before the show briefly about this. Before we get to the bond auctions, we had a gentleman on the program who very popular in the industry, but he has this very interesting theory that the bond market could have a melt up of colossal proportions a la GameStop type moves, because his argument was that on the 10-year and on some of these longer term maturities, they're looking at 2-to-1 short to every one long, because let's be honest, everybody who's in the financial world knows that the Fed, not Fed, but the supply of bonds is pushing prices down. So why not just short them? And if they are in fact short 2-to-1, does it truly set the stage for the ultimate melt up in the bond market, meaning yields collapse and the prices spike?
It's a great question. And I do agree with a certain premises that were embedded in there. Your prior guest was absolutely right. There is a huge short position in the bond market right now, specifically on the 10-year treasury, but also on the derivatives, the futures contracts as well. But let's face it, I don't worry about the shorts on the futures side because nobody's going to take delivery there anyway. Those contracts will be covered out, so we won't get a short squeeze there. But in the cash market, your guest is absolutely right. The dealers have huge short positions in the 10-year treasury, so we could get a short squeeze. However, I got to point out two things. Number one is we have increasing supply coming into the market. If we had supply even being a constant or diminishing, then I could see the short squeeze argument having some validity. But we don't, quite frankly. We know that the short position is large because in the bond market, like in the stock market, right? When you short a stock, you have to borrow that stock in a process called sec lending and stock loan, and I know you've talked about that. Well, when you short a bond, you have to borrow it as well, and that process is called a repo. And it's complicated. A repo is to bonds what securities lending is to stocks. And in the bond market right now, the interest rates you have to pay to borrow that 10-year have gone crazy. We actually have negative interest rates there. So it reflects this real strong demand that people need to borrow that 10-year treasury. So your speaker is absolutely right. There was a very large short position. But unlike the Reddit and GameStop situation, let's be honest, the capital required to get a short squeeze, as we've experienced in the equity markets, is not a huge amount of capital. But I would remind your listeners, the U.S. Treasury bond market is the deepest, most capital-intensive market in the world. Yeah. I don't think it's as easy to achieve a short squeeze there as we've seen in other assets. And we also have, again, I think the main issue is we have ever more supply coming into the market. That diminishes the short squeeze opportunity because we're just flooding the market with supply. That's why yields have gone up from 50 basis points up to 1.5% is because of all this supply coming in. So that supply isn't diminishing. So I don't fear the melt up short squeeze that your prior guest apparently feels is imminent.
It's interesting that you bring that up. And for those that are following the GameStop situation, which of course was crazy out there today, you want to talk about volatility. The GameStop stock has been going up and down more than Hugh Grant in the back of a taxi, for those that get the reference. If you look at GameStop, there's 69 million shares outstanding. So to put into perspective, what Bill's saying is The short squeeze in GameStop happened because there's only 69 million at the time, was trading at $40. It doesn't take a lot of capital to spike this exponentially, right? And then you trigger all those shorts. With the bond market, first off, you're dealing with far more money. I mean, it's a much, much bigger base. And imagine if in the GameStop scenario, it had 69 million shares. And then all of a sudden, like every day, it's releasing another 10 million shares. So even though it had such a heavy short position, the amount needed to buy to cover as all this new supply was flooding it would be muted. And I think that that's the point you're making here is, we're seeing more and more of this 10-year come on the market. Even though it's heavily shorted, when they do go to buy, they're buying from a greater pool and it won't have as much of a squeeze impact, right?
Exactly. And next week, when this auction settles, those bonds actually hit the market. The ones that were auctioned today hit the market next week. And when those bonds hit the market, we expect that repo rate, the rate you have to pay to borrow those treasuries, to diminish most greatly. Because, again, we got more supply coming in. Mm-hmm. We won't have that shortage that we might have, that we do have right now.
Right. With regards to the impacts today, obviously, I've got the visual up here of the yield curve. This is the current one, guys, and what's been concerning is how steeply it's been accelerating. You can see in 2019 is that upper kind of, I'm guessing that's light gray curve. At the bottom, you see one that I don't know, looks kind of reddish or whatever color that may be.
It's gray, unfortunately.
Well, I'm colorblind. I need like dotted lines and things like that. Then you look at the blue one, which shows just a much more accelerated curve. And it's been happening for the past couple of years. Now, with this situation where you have this yield curve sliding up, we talked about the Fed locking in that short end of the yield curve. What are we seeing the Fed doing now with regards to that long end? They're not sitting there with their hands off, right? Are they jumping in and buying the 10, 20, and 30 to help push it down?
Well, the Fed is on hold now, and that's what they've told us. What Powell told us at the last meeting of the FOMC was that we're waiting to see what Congress does and the stimulus checks and all of that. And obviously that is working its way through the process. We now got a vote and a resolution there. But the Fed is on, quote, what the Fed says is they're on hold. They're waiting to see the impacts of quantitative easing. But, the press hasn't picked up on too much. The Fed being on hold still means that the Fed is a big buyer every week, because they have the largest treasury portfolio in the world. Thanks to quantitative easing, as you know, the Fed now owns $4 trillion worth of treasuries. Well, those treasuries are starting to mature, and those treasuries also pay interest. So what the Fed is doing is they're taking those proceeds and reinvesting them back into the market to buy more treasuries. Mm-hmm. So the Fed being on hold, their portfolio is so large, they're averaging between $80 and $120 billion a month that they're jumping in and buying new treasuries to get that money working. I mean, on the 10-year auction today, let me get the number, the Fed bought $2.3 billion of the 10-year treasury today, and yet they say they're doing nothing.
Yeah. Well, I mean, and I get that. That actually makes sense to me, right? My assumption here is like to balance things out. You let that short end rise a little bit, which we know could hurt business, but you got to bring that long end down because all of a sudden markets are panicking. So you can't let that get out of control, and they have unlimited pockets, so they're allowed to do that. Talk a little bit more about today's auction, because you talked about some of the more recent purchases. Obviously, today was the 10-year bond auction, guys. Tomorrow at 1:01 p.m. Don't be late, right? Got to be there an extra minute. Tomorrow will be the 30-year. Now, today, do we get anything interesting from the 10-year today?
No, actually, and if I could, I'm going to go back a little bit further even, just to maybe explain why this is so important, because we actually have to take this back to the last week in February. As we've talked about on this show, we got a lot of supply coming into the market. And, the OTA community, we all know it's all about supply and demand. So what the auctions do is they give us a snapshot of what the demand looks like, because the bond market is over the counter. In a stock, you can go and you can see how many shares traded. You can see the liquidity, the short interest, because it all trades on exchanges for the most part. Bonds are over the counter, so we don't get that information. So what happens is these auctions that are conducted by the Fed for the Treasury, they give us a snapshot of what demand looks like. And we watch it closely. So on the last day in February, February 28th, we had a 7-year Treasury auction on that day. Now, that auction had the lowest level of participation for a Treasury auction in U.S. history. Wow. Not just more recently, but in the history of the Treasury Department. We've never had an auction because what we measure is what's called the bid to cover ratio, meaning how many more buyers did we have than treasuries we wanted to sell. Because the reality is, we here in the U.S., we're spoiled. There's a lot of global demand for our treasuries. We're reserve currency, countries have dollars, but we have strong demand. And it is always in excess of 2 to 1. We have at least twice as many buyers as we have actual treasuries to sell. But on that February 28th, when that auction results came out in the worst level we've ever seen, the equity markets dropped by 2.5% that day. I'm sure your people remember that last day in February. We saw long-term interest rates went up by 10 basis points. The 10-year Treasury went up to a 161 that day. One of the biases I bring is that, the bond market, I'm a bond guy. I'm a bond nerd. I admit it. I've always been in bonds. Bonds are the center of the universe as far as I'm concerned. But I think this week has shown that we have such contango, such correlation between interest rates and other assets. What's happening to the equity market right now is being driven by interest rates. The currency market, what's happening to the dollar. So this week is continuing with that supply situation. So on Tuesday, and by the way, we got $120 billion worth of long-term treasuries were introduced into the market this week.
Wow.
That's a lot of supply. $120 billion in just 3 days. That's why I don't worry about that short squeeze, just to give you some numbers.
Yeah, but, that makes a ton of sense. So, it's not like it's like a billion. This is $1 billion or $2 billion. Okay, fine. But we're talking $100+ billion. That is a monster amount of extra supply coming in the marketplace when you have the least amount of participation. That short squeeze, while it could happen, it may not be as magnified as prior thought.
Yeah, and the short squeeze is happening. We know the shorts are out there. So I just don't think it's going to be the velocity your guest said. So if we look at the auctions this week, just to recap them, and I think you might have a slide that could show this.
It's up there ready.
So the 3-year we had yesterday, and it was $58 billion. And now the bid to cover ratio in the last couple of auctions had been running about 2.4. So 2.4 times buyers than we had treasuries. Well, the auction yesterday was 2.69. We saw real good interest. So obviously strong demand means prices went up on bonds yesterday. Yields went down. The equity market liked to see that. So that kind of fueled what was going on with equities. Now, today, we had $38 billion of the 10-year. Now, the 10-year is an important one for the market. Everyone uses the 10-year as a benchmark. And we had the bid-to-cover ratio today on that 10-year, which was released at exactly 1 o'clock, you got it, was 2.38. Now, last month was 2.39. So we basically saw a steady demand. And that's why the equity market, which was already up on the day, really didn't respond to that news whatsoever. It was status quo. So the big question is going to be, what's tomorrow going to bring us? We got $24 billion of a 30-year being auctioned off tomorrow. And now the last bid to cover ratio for the last auction last month was 2.48. So it's a crapshoot. That's what it comes down to. But, we have seen diminished participation over the last 3 months of these auctions. Nothing has been better really than it was before. We're at least status quo, or worse, much lower, like we saw on the 2-year. Pardon me, on the 3-year, on the 7-year.
On the 7-year, right. Well, to me, this is the old adage, the trend is your friend until it bend at the end. And, we can measure trends everywhere. In this case, it sounds to me like the trend is obviously a lower bid to cover ratio, which essentially means less participation out there, which is not really a good thing, guys. Obviously, in life, when you have more competition for something, whether it's a home, a car, baseball cards, or whatever, that will support and push prices up. In this case, the lack of participation, the really low bid to cover ratios, is what's causing prices to continue to the south side. Even though it's a heavily shorted instrument and there is some short covering, it's still drifting down. Now, what do you see changing this? Is there something that might come to market that's going to all of a sudden pop this back? Is it going to have to be the Fed or the Treasury saying, we're not going to sell any more 10-years?
Yeah, no, and that's not going to happen. In fact, the reality is just the opposite, which is why I'm continuing to call for higher interest rates long term. As we've been discussing, here comes my Fed dance. The short end of the market is locked in at 0, and the Fed has told us they're going to keep it there. The market doesn't believe it. The market still keeps thinking that, we got to worry about inflation. The Fed has told us don't worry about it, but we still worry about it.
Yeah, of course we do.
But anyway, so the short end is locked in at 0. But this supply just keeps coming in, which is why I'm on the other side of the equation from your other guest. I continue to feel that this onslaught of supply is like anything else, right? You get an onslaught of supply, that drops prices, and in this case, that makes yields go higher. I mean, the good news is today we got a stimulus package, right? I mean, I'm a small business owner. I consider that to be good news. But please understand, we just passed a spending for 1.9 trillion that we don't have. Right? I mean, this is going to increase our deficit by 1.9 trillion. So, I'm a hypocrite. I love the stimulus, but I worry that the cure could be as bad as the disease in the long run.
Yeah, kick that can down the road. Our kids will worry about it. Don't worry about it. It'll be fine. As long as me as an elected official make this all go away and I can be dead by the time the impacts hit. Bravo.
Or my cynicism is every political party always worries about the deficit when the other party is in power.
Yeah, right. Well, this isn't taking sides or voicing that we're Democrat, Republican, Independent, saying it's a completely screwed system, folks. So.
This is bipartisan. This is not a shot at any one political party, but we all know you only care about it when the other party's in power.
Absolutely. All right, let's go to a couple listener questions here. This is from Christopher Lee. Hello, Chris. Good to see you. He says, Bill, I have a question for you. One day last year, I accidentally turned on CNBC. Sorry, these accidents do happen, Christopher. And he heard them talking about the possible 100-year bond and bond rate. Do you think such a thing is possible? And if so, what strategy would you use to invest in it? You talked about the 100-year before.
Yeah, that's a great question. And, certain countries have experimented with the 100-year. Mexico successfully placed a 100-year maturity bond last year. I like the idea in today's interest rate environment. I would like to see the U.S. government start issuing longer and longer maturities. Right now we're stuck at 30 years as we have been for 35 years now. And other countries are issuing 50-year. Europe's issuing 50-year. I hate the fact that our government has to borrow so much money that we overspend. But if you look at today's interest rate environment, the yield curve you were just showing, at least the good news is we're borrowing money at historically very low levels. Yeah. Historically speaking, the U.S. government can borrow for 30 years and pay 2.5%. From the government's point of view, that's attractive. So in today's interest rate environment, with the government having to borrow so much, I would love to see them issue longer maturity bonds. Let's lock in these low interest rates for as long as possible. Unfortunately, under Steven Mnuchin, when he was the Treasury Secretary, he specifically told us the Treasury Department would not be doing anything longer than 30. And honestly, he never offered an answer as to why, because the marketplace really would like to see it. Your participants know the whole concept of duration. The longer the maturity of a bond, the more volatile it is. Well, if we start having 100-year maturity bonds, that's going to be a hell of a very volatile vehicle. Yeah. So for trading purposes, the 100-year would be fun. Also for client purposes, insurance companies and pension funds, that would give them the opportunity to fund their liabilities going out 100 years. So personally, I would love to see us have longer maturity bonds. The marketplace would. The Treasury Department seems very reticent, and we really don't understand why.
Yeah, I'll tell you, maybe from a trading perspective you like it, but as someone who trades, or as an investor, I wouldn't do it. I wouldn't put my money in a 100-year bond. First off, I'll be dead by the time it comes around, so I'm not going to get my par value back. Number two is, if they're going to pay me, let's see, right now you're looking at 30-year, I'm going to get around 2.25% for a 30-year. Right. What are they going to pay me? 4%?
Again, that's a function of what I can't answer that.
I know, I'm just guessing, but you would assume a natural yield curve, 4, 5, 6%. It's like, man, I'd rather tie my money up in something that might give me a better rate of return, because that is such a long time frame of we don't even know what the hell's going to happen by August of this year, let alone 100 years from now.
Oh, yeah, I don't see a lot of retail application to the 100-year, honestly, for the reasons you said. But for insurance companies and pension funds, some of those institutions, they would love it. Where I see an application for the retail side, though, is not as a buy and hold investment. You're absolutely right. We'll be dead before it matures, but as a trading vehicle. Yeah. You start setting up some zones because you're going to get a lot of volatility on a 100-year bond. Sure. I mean, literally have 3 times the volatility of the 30-year. That's a lot of volatility. So, for strictly trading purposes, the 100-year could be fun for your audience.
Could be fun. Brendan, you're funny. He says, would you rather buy 100-year bonds or Dogecoin? You're basically, that is not even a close comparison out there. I would buy Dogecoin myself, just because I wouldn't have faith in the 100-year. I'd want to see more action and volatility. And especially a lot of these crypto projects, I'm not going to be around in 100 years, but in 10 years, I'd rather, buy a few of these different altcoins and see which one's around in 10 years, and I'll probably do a lot better than that 100-year.
I don't disagree. I'm not here to recommend the 100-year for a
Yeah, no. It's just it's an interesting product, and I love getting your perspective on it. But, you mentioned the stimulus, and obviously, we could go into the different areas of the stimulus program that went out. It was signed today. Of course, everyone's so excited about getting those checks. By the way, if you do the math, it's $1,400 per person for 300 million people. You know that there's no way on earth 300 million people are going to qualify for this. So I wonder where all that extra money is going to go. Anyway, one of the questions from one of the viewers was, I don't remember the name, was asking about what impact do you think that stimulus is going to have on the markets overall? Do you have a thought on that one?
Honestly, I think again, I'm going to venture into an area that's not my area of expertise, which is the equity market. But, I've also seen surveys showing what percentage of the population is going to take that stimulus money and put it into the market. And specifically the equity market. So, we seem to have a lot of disposable income these days. And I know that's hard to believe for some people, but, the savings rate has gone up. I think the stimulus package is going to be good for the equity market. I think it also is good for long-term interest rates going higher. Because remember, the whole reason long-term interest rates are going higher is the prospect of growing inflation with a stronger economy. So if this stimulant really is a stimulant, that should help the economy chug along. That'll increase inflationary pressures and lends even more argument to a rising interest rate environment.
Yeah. My thought is that it's already priced in. My hope is, and I would hope that all my viewers encourage those that are getting the stimulus checks to do what you should be doing with it. Paying down your debt, right? Putting yourself in a better position. It doesn't mean, well, great, the Fed said I can go buy a frickin' TV. No, that's not what this is for, Do something wise with it. Pay down your debt. Improve yourself, but don't go out and buy a bunch of crap with it that you just don't need. So, sorry, I had to throw that out one again. It just frustrates me that I think the first time we got the checks for $1,200, Walmart ran a special for like an 85-inch TV for $1,200 exactly. Kind of nice.
Those I literally since it was just passed, I'm already starting to get those spams myself. Here's how to spend your stimulus check, where they already started.
Drives me nuts. All right, I got I got two questions. One, and I forgot where the first one went, was back here. Let's start with Savas. Savas said, what would happen if the Fed rate is cut? So obviously, the Fed funds rate is, we'll just say at this point, 0 to 125 basis points. What happens if we cut this? I mean, is it stupid to do because the long end is rising?
Yes. And there's nothing to be gained from it. Because to cut from 0 obviously means the Fed would then start introducing here in the U.S. negative interest rates. Mm-hmm. And, for those countries that did experiment with negative interest rates, when the pandemic first hit, some countries did go negative on their interest rates. And it creates such distortions to the market. There's really, most of the readings I'm seeing say that for those countries that went negative, they really didn't get any advantage out of that over going to 0. So as, Alan Greenspan was quoted, and I famously quote him last year, where he said, 0 is just a number, meaning we could go lower, not that he was prophesizing it. I think for all intents and purposes, we do have a floor at 0. There doesn't seem to be much gained. And the other reality is the only reason the Fed would cut is if the economy starts acting weak. Well, at this point, I think they'd be much more inclined to do more quantitative easing than they would be to cut interest rates to negative.
Yeah, absolutely.
They're comfortable with printing money.
Yeah,
they've proven.
You never know what they're going to do, but I think if you go negative, I think that might actually alter that yield curve even more significantly from a slope perspective, and probably wouldn't be the most prudent thing. And they're kind of between a rock and a hard place. You don't want to go negative because that skews the curve, and then you don't really want to raise because you start screwing the economy or screwing with the economy by raising that short end. So it's a damned if you do, damned if you don't kind of situation for the Fed. I'm glad I'm not the one running it. We should get you in there. You got more experience than some of these guys. Come on.
You don't want me in any government position. I'm here in Washington, D.C. because of family, not because of politics. So
that's exactly why I would want you to run the Fed.
That's right. I live in the swamp, so that's good enough, close enough for me.
Let's see, what else do we have? Baldhead B says your OTA general session last week was great. When is your next one going to be? Do you know?
Yeah, we're starting to do more. I'm starting to do more with the community here. Good. So I have another XLT on March 16th. Which will be my second one in the month, and then we'll go on to a monthly schedule from there. And then the other program that's we're building up for is in May. We have the next signature series where we do 3 days really concentrating on interest rates, the economy, bonds, but also how interest rates, like we've been talking today, affect so many other asset categories. It's not just for the bond people, although it's called bond aid. So we have that coming up in May. So we've got the XLTs and that. So I'm keeping busy with you guys. I enjoy the audience.
Well, the feedback's been really great on all the stuff that you're doing. Obviously, I'm one of your biggest fans out there. So I love the constant content that you're producing, and obviously coming and doing sessions like this where you're sharing information. It's awesome. Guys, you can find out more information. If you want to know XLTs or his teaching schedule, if you go to OTA, my OTA, and just click on the calendar, you can actually type in his name, and it'll tell you all the different events he's got coming up here, whether it's an XLT general session, Clubhouse, Mastermind, or his signature series, which is called Bond Aid, which is pretty awesome as well. Let's see. Christopher, I have a question. Let's say that the bank savings interest rates become negative. Where would you suggest someone put their emergency funds? That's a great question.
That's a great question.
And very subjective. By the way, first, before you say anything, Bill and I are both not licensed financial advisors. This is opinion-based. Do so at your own risk. I just got to say that because nowadays someone's like, you told me to do this.
Right. No, the problem is you need liquidity. If you're keeping money short, it's because you need and want liquidity. And that's exactly the problem with a negative interest rate environment. In the question your person is asking, they're illustrating what is the problem. Because if Treasury, the Fed brings down short-term interest rates negative, other interest rates are going to go negative as well, like bank savings rates. The rest of the world has negative bank savings rates. We still have positive. So the problem is if the Fed goes negative, you really have nowhere to go with your cash needs because, my first inclination would be, well, go out further out to maturity. Because if the yield curve is positively sloped, if cash goes negative, at some point it'll go positive. But if you got to go 6 months, a year down the road, it's not cash any longer. Mm-hmm. So the unfortunate reality is if Treasury yields go negative or the Fed goes negative, other interest rates that are going to follow, like bank rates, CD rates. Mm-hmm. There's nowhere to go. That's exactly the problem. So I don't have a better alternative if liquidity is your primary need. If you need liquidity in this environment, you have to give up yield to the point that we're now negative.
I would say, from my perspective, Christopher, I would probably agree with Brendan here and say gold or commodities, precious metals, because if you have all of a sudden the yield going negative, dollar's going to get crushed, right? No one's going to want to be holding dollars because you lose money holding it. So they'll be seeing exodus from the dollar. That could have a big impact on commodity prices. So I certainly would be looking at gold. Of course, I'm going to be a fan of Bitcoin here because you can't manipulate it, but that's probably the most extremely risky thing that you're going to talk about as far as an investment. You just got to be able to embrace some volatility, as you've seen over the last 48 hours. It's been pretty crazy. Other than that, it's kind of difficult to say. I mean, it's weird to think that if I just keep the cash under my mattress, I don't lose money. But if I keep it in some of these accounts, if we go negative, I will literally be losing money. It's kind of an odd conundrum to be in. Hopefully we don't have to cross that bridge, although my gut tells me at some point in the future, we will be looking at negative rates where it's like, hey, got my JP Morgan Chase account, put $10,000 in it, I'm earning negative 0.1% interest. Like, hold on a second. I'm paying you to hold my money? I will hold it here at my house. So
basically, that's exactly what's going on in Europe right now, as you know. That is exactly what's going on in Europe. So we're very fortunate.
Yeah, bottom line, if we do go negative rates and you are keeping cash at your house, you probably want to go invest in Smith & Wesson stock because I would probably own some handguns or Mossberg or something like that so you can protect your own home.
There's not much to worry about that.
Yeah, I know you're not a currency guy, but obviously you've seen the bond relationships to the dollar for many, many moons. What's your thought on, this is a question that came in from Alan. He says, I'm sorry, not Alan, Medic Mandown says, if we go negative... Wait a minute, where did it go? Someone just retracted it right as I was going to read the question. Thanks, FX Green. I was just going to read your question. You took it away from me. Damn it. Well, there we go. That's the beauty of being able to retract your questions live in the chat is great. Yep. Negative rate, bank rates, and people have to pay the bank to hold their money. Yes, that's the weird part about it. Yep. Here it is.
And that's exactly what's going on in Europe and has been for the last year. We are really more fortunate than we realize.
Yeah, it's I don't know. It's just so counter everything I learned at my Keynesian finance university, which is, you get rewarded for keeping your money somewhere. We're taught we have to save. Great, I'm putting it in a savings account. That type of thing is just crazy. The question from FX Green was, what's your outlook for the dollar index, so the Dixie?
Well, and the question really becomes, and I'm a dollar person, and I don't know the weighting of the index, so I'm gonna hedge on that. But let me say this: I do think it comes back to interest rates and central banks again, because, I don't know if you caught it on the news just today, the European Central Bank has now beefed up their quantitative easing program. They're already at 2 trillion, and they just announced today they're doing more. So, they're going to be putting more euros into the market. So the dollar is going to be strong relative to the euro, obviously, based on that. We also have the situation the UK is doing a phenomenal amount of quantitative easing now. We're on hold,
right?
But the UK is doing a huge amount of quantitative easings. The Bank of England right now owns 30% of all of the treasuries in the UK, and they're continuing to buy. So the dollar is going to be strong against the UK on that. So I tend to look more at what the other central banks are doing versus us to look for that. And when I see the rest of the world printing money, and right now we're not, looking good for the dollar.
Yeah. All right. Well, it's funny because I've had so many people think the dollar is crashing, and others think the dollar is going to go up. This is what makes financial markets work, folks. And I think regardless of whether you think bonds are going up or down, or dollars going up or down, or markets going up or down, as long as you have supporting information for your choice and you have rules in place, entry, stop loss, price targets, then act on what you guys feel. Baldhead B says, isn't the USA doing QE2?
Well, we're way past QE2. We did QE2 back in 2010, and then we're up to QE4.
Yeah.
And the Fed, what did QE4? We've talked about it. They did 3.6 billion of quantitative easing last year in 6-month period. They did more QE last year than during the entire 4-year financial crisis. But since the end of the year, our Fed has been on hold, specifically telling us we're waiting to see what the government side does. So we're the next one will be QE5, I guess, is what the press will call it.
Yeah, well, Operation Twist is another one that people have been talking about, like bringing back Operation Twist, which was, you want to explain Operation Twist? Because that might be fresh.
And the Fed has a portfolio. It's a great question because Operation Twist back in 2008 really did impact the bond market. But, as we've been talking about, the Fed has the largest treasury portfolio in the world, thanks to quantitative easing. And once they own those bonds, they can also be adjusting the maturity of that portfolio. If they want to do some yield curve manipulations, they could maybe selling their 10-year treasuries and then buying 30 years against it. Mm-hmm. In other words, once they have this portfolio, the Fed can then be going in and out of different maturities to do, it's quite frankly, yield curve manipulation, for lack of a better. And they do that. That's what Operation Twist is. They're going to twist the maturities, and they're going to play with the portfolio.
Yeah, manipulation, I love it, but no, we'll just call it Operation Twist. They should just call it, curve manipulation. That's what we're doing. It's curve manipulation. No, it's Operation Twist. Sounds so nice. It's twisting. We're twisting the whole yield curve.
And the press loves that. Quantitative easing, is currency manipulation. I loved it when our former president talked about China as a currency manipulator. I just had to laugh because we had the largest quantitative easing program in the world. We were the largest currency manipulator.
It's like, someone who's in jail for grand theft going, hey, well, you're a thief. It's like,
right.
No, you are.
Right, exactly.
Brendan asked a good question, too, and then we'll try to wrap things up here.
Brendan, good to see you.
Yeah. He was saying, who's buying these bonds, and he said with a wink, because it's like saying not many people are buying them, but you have a graphic here, which I think maybe we can show, that talks about the different participants. And you mentioned, the Federal Reserve kind of being the biggest buyer of them all, but walk us through some of these participants so people realize it's not just a bank, right? It's not central bank.
Oh.
There's a wide variety, and each one of these has a major role in the auctions and the purchasing of these treasuries.
That's right. So the way it works is the government is actually selling the treasuries, right? The government needs the money. That's why we sell the treasuries. But the Fed acts as the auction house. In other words, the Federal Reserve actually conducts the auction, and then they turn the proceeds over to the Treasury Department. But at this auction, like we had today, so the U.S. government sold, what did we say, to 38 billion of the 10-year today. Mm-hmm. So on the chart that you've got there, we're showing who the different participants are at this auction. Now the first one is the most important, because here in the U.S. we have a system of what's called PDs, primary dealers. And right now there are 24 of them. These are firms that have applied to the Fed to get this status. They want this status. But when you become a primary dealer, it then means you have to participate in every single auction, every one. And as a primary dealer, you have to step up to the plate and you have to bid for as much as 4%, at least 4% of every deal.
Wow.
And any individual dealer can also bid for as much as 35% if they want to try and, snap up the market.
Now, before we go further, you say Yeah, you see there it says 4% of every deal. Do they have to be competitive in their bid? So say for example, right now, your ask price is, I'm just making up a number. Your ask price is 100, and the bid price, they don't have to buy it at 100. They can, my bid's going to be 75. It's like way outside the market, but technically they are bidding, correct?
Correct. And that's it exactly. And that's why you don't have to buy 4%. You just have to bid for 4%.
Oh, that's ridiculous. Yeah. It's like me being I don't know, a real estate investor, and I have to bid on 10% of the properties that come to market. And you're like, "Oh great, this house is listing for $600,000. I'll bid $1." I'm still bidding on come on.
Okay, but follow that same logic, and I agree with you 100%. But what if the majority of the dealers feel that way? What if the majority of the real estate investors feel that way, and everybody bids $1?
Yeah.
What just happened to the results of that auction?
Yeah, it's falling quick.
Bingo. I'm not disagreeing with you. Well, it could happen, but realize the implications of that are horrendous.
Yep.
But so the fact we have 24 dealer firms and they have to buy 4% each, even if they all only bought the minimum, there's 96% of your treasuries are sold right there. Mm-hmm. So we will never have a failed auction here in the U.S. We have a rigged system. We have these primary dealers that have to participate. Back in the financial crisis of '08, you might remember, Italy and Portugal, they had failed auctions. They tried to raise money to run the governments only to find that there weren't participants willing to buy them. Right. We'll never have that problem because of this primary dealer system. So it's a rigged system in that regard.
It is. It's rigged. It's interesting because we're guaranteed to have an auction. We just don't know what that price is going to be.
Bingo. Good. So they have to be there. Now, the rest of the audience that we have on the list, they can come and use it as they want. So they have more flexibility. But the one we already mentioned is the Fed. When the Fed comes in and participates in the auction themselves. So this is like Sotheby's selling off artwork and then Sotheby's themselves deciding we want to buy it. So the Fed is auctioning off the treasuries, but the Fed's also buying them. Again, they bought over $2 billion of the 10-year today. So they come in on an as-needed basis, and it's identified. In the auction results, we get all this data. So the Fed can be there and use it when they want. The other big participants, as we know, are foreign central banks. And when a foreign central bank comes in and buys our treasuries at the auction, they have to register as such. So this is a way we can get an idea as to what type of foreign participation we're getting. Mm-hmm. And it's less. Quite frankly, Japan and China have pulled back. The oil countries that got so many dollars for selling oil, the price of oil being down where it was. So same like Saudi Arabia and Kuwait, which used to buy a lot, aren't buying as many right now. So we have those. Now, the other is big institutions like a BlackRock or a PIMCO or an Alliance. They actually have the system that they can go in and bid themselves, just like a dealer. We give them access to the auctions themselves as long as they meet a certain qualification. So the bigger portfolio managers, asset managers, they can participate directly in the auction. And then you also have large firms that do it through the dealers. I don't want to submit a bid myself. I'll give Merrill Lynch, Bank of America a bid, and they can put it in for me. And then the last group is the retail investor. You and I have the opportunity to buy treasuries directly through a program called treasurydirect.gov we talked about. Great program, buy treasuries for free. Well, those buyings go into this auction as well. So there's a whole universe of buyers. So, if you think about it, we're selling the most amount of treasuries in the world.
Yeah.
And yet we still have twice as many buyers as we actually have treasuries to sell. That is pretty impressive.
Yeah, absolutely.
Continues.
Yeah. Great question here from multiple. It says, who owns the Fed? Guys, the Fed is technically nobody owns the Fed, but it's basically run by member banks. It's what you're looking at me. You don't think anybody owns it?
Yeah, I am respectfully disagreeing.
Okay, good.
The Fed is a corporation with shareholders.
True, it's got shares. Okay, so I guess
the Fed. So it's a corporate structure that has ownership, and the owners are the banks.
Yeah.
If you're a federally chartered bank here in the U.S., you are legally an owner of the Fed because you own Fed stock.
Which should make everybody very wary of the Fed. And again, there's a lot of people that feel, abolish the Fed, et cetera, and that's a discussion maybe for another time. But here you have an entity that's really made up to protect the banks, run by the banks. So it's the old adage, the inmates running the prison, so to speak. And there's definitely some truth to the potential for very favoritism policies towards banks, which I think we've seen happen over the years.
Well, and I'll give you one right now. And I have to say it in the interest of full disclosure, the Fed is a client of mine. I do training at the Fed. We've talked about that. But I've even said at the Fed, after the financial crisis, our Fed kept the Fed funds rate at 0 for the next 10 years. Mm-hmm. For 10 years, the banks had the opportunity to borrow money at 0. Well, if you can't make money borrowing at 0% interest, you shouldn't be in business.
Let's make it negative. It's easier to make money.
Well, that's it. Making it negative. But many people feel, myself included, that the Fed keeping that Fed funds rate at 0 was basically just a bailout of the banks. It was the Fed bailing out their owners.
Yeah.
The Fed is owned by the banks. And I'll say it real quick for the group. It was founded in 1913, and it was founded as a for-profit corporation. The Fed as a corporation has made money every year since 1913.
I don't think there's a corporation alive that can make that statement other than maybe the Fed.
Really? And that's without having to, and that's without the printing money, which they also have the authority to do. That also makes for an interesting corporation when you can print money. I have a corporation. I can't do that.
Yeah, right. I wish. I wish we both could. I'd be working for you and you'd be working for me. Let's pay each other. When's your next bond aid? I know that you mentioned that you have an XLT general session coming up on the 16th. So next week you're going to have an XLT session. I would encourage all of you to join that if you are Online Trading Academy members who have XLT access. Check that one out on your calendar in my OTA. When's your next signature series?
The Signature Series Bond Aid is going to be the first week in May, Tuesday, Wednesday, and Thursday, which I think is the 2nd, 3rd, and 4th, if I'm not correct. But the first week in May, Tuesday, Wednesday, Thursday, 3-day series. And we get pretty comprehensive. We get into all the different asset categories of bonds. We get into the analytics, and we talk about the other asset categories. So this will be our 4th one. We've had a lot of fun with these series.
Absolutely. Awesome. Well, I think I had it up there on the screen. I've had it up there the whole show. If you want to contact Bill, go to LinkedIn. That's the easiest way. He posts a lot of great articles on different bond and market-related things of the Fed, etc. It's under William Addiss. On LinkedIn. You can check him out there. And man, thank you so much for coming on. It's a timely day. I'm sure that you'll be sitting there with a bowl of popcorn at 12:50 in the afternoon tomorrow watching the bond auction.
You know me well. I am a bond nerd. I can't wait for 1 o'clock tomorrow to see what the results are. It's going to be a crapshoot, but the markets will react one way or the other.
And do you walk into these with expectations? Like, I'm expecting that, that bid to cover ratio to be much lower? Or?
I've been impressed by the fact that the 3-year and the 10-year went so well. I'd be surprised if we get 3 in a row that go well.
Yeah.
I'm thinking the 30-year could be our problem tomorrow. If I were a betting man, I'd bet it's going to be a low participation. But the other ones this week have been strong. So it's going to be a crapshoot. All
right. Well, I'm looking forward to it as well. And of course, if we were to get a real low participation rate, that means the equity market's probably going to have a little bit of a hiccup tomorrow as well. Bill, thank you so much for coming on. I do appreciate that. As always, I'll probably get you on here another month or so because we have more bond auctions next month.
Perfect. I always look forward to it, Merlin. Pleasure working with you in the OTA community. I really enjoy it. So thank you.
We love it too. Thank you so much, man. Have a great one.
Be well. Peace out. Be well.
Guys, that was Bill Addiss giving us some insights into the bond market. Obviously, there's a ton of information there. We just kind of scratch the surface and go quickly through a lot of major topics. If you are interested and would like to know more, obviously contact your local online trading academy. He does a general session XLT, which is going to be March 16th, and I think he said in May, he's got his signature series, which is called Bond Aid. It's all about bonds, much more in depth than what we're looking at right here. And as you can see, some people in there in the chat were actually mentioning it earlier. It's a pretty great class. I haven't had a chance to sit through all of it because I've been busy, but boy, I love when I do jump in there and see just the content. And, for me as somebody who's, I guess, always a student of the markets, this is probably the asset class I knew the least about. And Bill Addiss has really helped me understand it and see the significance of it because the bond market really just moves the world. It's all about bonds and money, not just U.S., but globally as well, and currency markets too. So pretty awesome having him on. All right, what else do I got? Let's see. So is the market still bullish? I mean, you got a lot of chop out there today, man. I mean, it's not like it was great market direction by any means. Let's go and show the equity markets. I'll start with the S&P 500 so we can take a peek there. Your daily, the last couple weeks have been chop. I mean, granted, big swings, but we're just bouncing. What's nice is that previous low that we saw last week, we didn't break it, right? That's a great sign that we didn't break that low, but we haven't broken the highs either. So at this point, you could argue that we are range bound, kind of traversing back and forth. I'll have to make an assessment once we get out of this, but right now it's looking pretty strong. Tell you what, if we do get a very low participation rate tomorrow for that 30-year, you could see the equity market sell off a little bit. And of course, the other indexes are looking pretty similar. You have Russell 2000 at all-time highs today. NASDAQ getting a little bit of its feet back under the ground underneath it yesterday. Today, yeah, not that great. Not that great. All right. So where can you watch the bond auction? I don't know where you would watch the bond auction live, Gems. I know that you can go to the Treasury Direct, but I'm not sure if they give you a live feed of it when those numbers come out. But a future show idea. What are SPACs? Indigo Clover. There is a show on SPACs. If you go to the TraderMerlin YouTube channel, just go to YouTube, type in TraderMerlin one word, click on the TraderMerlin part, and you'll see a whole list of shows. Type in the search there. I believe I called it's SPACs Necessary Evil or something like that. If I have a second here, maybe I'll see if I can dig it up for you. Shooting star scares me, Kevin says on the candle formation here on the NASDAQ. Yeah, it's certainly not that great. We don't have really high volume on the NASDAQ futures to accompany that. Like the shooting star that Kevin's referencing is the candle that formed today. Not a perfect one. It's a little bit higher up than I would like, but still showing overall weakness. It's a red candle, longer topping tail than bottoming tail. Now volume, if volume was much, much higher, then I'd feel much more enthusiastic about a short trade tomorrow. But, I think it's one of those things that you just simply watch and you say, all right, if we get below the lows of today, and you can probably do this on the Qs. What you do on the triple Qs makes it a little bit, that's not going to work. The triple Qs didn't work because it doesn't show that 24 hours. So go back to the NQ. You wait for that break down below 12,705. If we get that, then I think you got a short opportunity. But again, you want to wait here. It seems like the other indexes are acting rather strong. Are the other indexes right and the NASDAQ is wrong, or is it just a separate race and the NASDAQ's going to tank because technology? We'll have to wait and see, but I would wait for confirmation on that one. So Indigo, yeah, check out the show on TraderMerlin's. I think I did a decent job in explaining SPACs and kind of why they are dangerous and what some of the issues are with them. I am invested presently in a SPAC, but they are a crapshoot. To me, it's absolute gambling. Christopher Lee says, can you please tell me what exactly is the Russell 2000? It is an index of securities, 2,000 of them, that are under a specific market capitalization. They are small cap companies. So you look at Dow Jones, these are the multi-billions and maybe even trillion-dollar market cap companies, the blue chips, if you will, and 30 of them. Russell is taking small cap companies, so not necessarily penny stocks, but smaller capitalization companies, and it's a measure of kind of that small business in America, they would say. That's really what it is. Yes, Medic, I'm still in VIH. I actually almost bought more when it hit 12. You guys know my entry price is 15 on VIH. I didn't even look at it today. Yesterday was an ugly one for it. Last few days. Actually bouncing upward, 1460 on VIH. And guys, the only reason I own VIH is because I feel so strongly about a publicly traded cryptocurrency exchange, and this is a SPAC that bought them, so I presently own 1,000 shares of it at 15. I should have bought more myself, but I got other things that I'm invested in. So yes, Medic, I am still in VIH, 1,000 shares at $15. Okay, let me go through economic calendar because you guys are just dragging me into a 1-hour show yet again. See how this goes. So funny, when I first started this, I'm like, I can allocate 30 minutes a day to do this show, and here I am doing an hour a day for you guys, the things I do for love. All right, here is what we had happen. I'll go through some of the stuff for today, and then we'll go to some of the stuff for tomorrow. Here's what we have for today. Now, what was interesting with this was the economic news. Our CPI number was right in line with expectations. No real surprise. You look at the food and energy removed from CPI, food and energy. Yeah, you had actually a decrease in it, so that's actually pretty good. Canada, no big deal. Expectations with their rate announcement stayed right in line at 25 basis points. But then here's the real shocker, was crude oil inventories. You had an expectation we were going to drop from 21 million barrels to 3 million. We only dropped to 13, so we still have a good amount of supply of crude oil. Now, the thinking there is that this might start to impact crude oil in a negative way, but really didn't do too much, right? You didn't see, you actually saw a positive up day for crude oil today. We'll have to see how that pans out over the next few days. But all in all, that's actually a bad thing for the price of crude oil, because that means supply is much higher than expected. High supply, demand staying the same, prices should, in theory, drop. Of course, we know in theory, a lot of things just don't come to fruition. What else do we have for tomorrow? Here's your economic calendar in red. I'm boxing out the U.S. stuff. You can see we've got job unemployment claims, JOLTS job openings, natural gas storage, and of course, that 30-year bond auction, which is at 1:01 p.m. Eastern, 10:01 Pacific time. Right now, they're expecting that bid to cover ratio to be 2.2 and the yield at 1.93. We'll have to wait and see, but I assure you, if that number comes skewed and is out of line in any way, markets will get very volatile right around 10 o'clock in the morning Pacific time tomorrow. Now, the UK, reeling from their wonderful interview that I refuse to waste my time and talk about that stuff, the whole political side of it and just this soap opera. Yeah, we wanted to get out of the royal party because we didn't like drama, yet here we are in Oprah Winfrey spreading all of our drama. You gotta love social media and how people like to be influenced, isn't it? Anyway, they have their own issues tomorrow. You've got GDP numbers, construction output, goods trades balance, index of services, industrial production, manufacturing production. It's a big day for the British pound tomorrow. And of course, before our markets even open, you're going to have a press conference from the ECB talking about their main refinance rate. Right now, it's expected to stay at 0. I've heard chatter about them talking about it going negative, although, I mean, that'd be a major step. My guess is you'll see it come in line at 0 and nothing really change. Okay. That is, I believe, all that I have. Oh, no, I have earnings tomorrow. We talked with Tim Blotzer yesterday. He likes to do earnings plays on stocks that are, over $100 and have a good amount of volatility. Well, there you go. We have Ulta Beauty coming out tomorrow. I think, at $300? They'll be reporting after-market close tomorrow. It's going to be very volatile. We also have JD reporting earnings tomorrow, which is a much bigger company. That won't be before market open there for JD. All right, that is it from the economic perspective, the earnings calendar. Can you talk about the cryptocurrency pie tomorrow? Not tomorrow. Tomorrow I'm going to have Larry Jacobson on the show. We're going to talk about portfolio and kind of longer term stuff. I've kind of set aside Friday's show. Normally, it's about what happened in the week. But I have I have pages of cryptocurrency questions. And I'm trying my best to keep the show balanced in talking stocks and bonds and futures. I think Friday predominantly will be a crypto show since it's become so popular. So I'll look at pie on that one and try to get to many of your listener questions. If you have things you want me to cover, not just crypto, anything market related or questions for Larry Jacobson for tomorrow, you can email me. It's at TraderMerlin@gmail.com. That's the easiest way to get in touch with me. You can also, obviously comment down below the YouTube video. That does help out. I know we got some new people here today, so welcome aboard. You can feel free to hit that subscribe button as well, so you'll be notified when I get when new content comes out, etc. That said, I hope you guys enjoyed today's show. Merlin, I noticed GBTC is still at a discount on Bitcoins. Do you know why? I was going to save that for Friday, but I'll wrap it up with that piece. We've talked about this a bunch let me see if I can actually bring up that chart for you. I do know why, and there's a lag effect between, so let's bring that up over here, full screen for everybody. And nice try there on trying to get me to stretch this show out, huh? Way to go there. Way to go, ball-headed bees. All right, so here you go. It's actually, so I think it should be flipped now. Let me put a line on the 0 because I just redid this one because Tom gave me some better numbers and flipped the whole thing. So basically, anytime it's down below this line, it means you're buying GBTC at a discount. Why is it at a discount right now? Because the price of the price fluctuations of Bitcoin have been so dramatic. Remember, this portfolio, GBTC, it's a trust that has to own physical Bitcoin. So what's happening is as Bitcoin is moving quickly, GBTC has to do two things. They have to look at the price of Bitcoin and say, we need to keep exactly enough amount of Bitcoin in this trust to accommodate the amount of inflows and outflows. So if all of a sudden there's a bunch of sellers in GBTC, it skews the amount of Bitcoins they have and changes the value of the portfolio. Simple example. Let's say that they have one Bitcoin in GBTC. It's much more than that, but I'm using this for basic math. If you have one Bitcoin in this fund and you have 1,000 investors, then GBTC should be just about the price of 1/1000th of a Bitcoin, right? So let's say that Bitcoin is currently trading at Let me just bring up my GBTC here. Let's call it $57,000. So if I have one Bitcoin in this fund and 1,000 investors, then my fund should be worth what? $57 a share. But what happens if instead of 1,000 investors, I lose 500 of those? I now have 500 investors. How much is each share worth? It's worth $104, $114, right? 57, yeah, $114 a share. So what I have to do is, if all of a sudden the number of buyers in my fund is cut in half, I need to quickly cut in half the amount of Bitcoin that I'm holding so that ratio stays at 1,000 to 1. That's what they're stating they're doing. So as these fluctuations in price of Bitcoin are moving so quickly, there's inflows and outflows to the tune of tens of millions of shares per day in GBTC. Let me make sure I'm right on that one. Yeah, tens of millions. I think today you had a total of 12 million shares of GBTC traded hand. It seems to be doing about 10 to 12 million. As those inflows and outflows happen, they have to automatically be adjusting this. And you're going to get imbalances there where they're not exactly on. That creates that premium or discount that you're buying or selling at. There you go. Hopefully I conveyed that clear enough for everybody out there. Did I get you? All right. I don't think technical vulnerability is a big risk to Bitcoin, but you'll have to keep me a loop. Yes, as I told you, I have a program that I'm running right now, and I run it every single day. No luck in my theory, in my thought, but I'll let you know. And I'm pretty sure I'm going to get some. It'll be fun when it finally happens. All right, guys, that's going to do it for me. I've got 3 minutes left, and I'm not going to let you take me an hour today. Again, Larry Jacobson will be the guest on tomorrow's show, so if you have anything regarding long-term portfolio theory, anything really to do with financial markets, Larry can cover all of it. The other side of things, if you want to see Bill Addiss in action, he's doing a signature series, he's doing an XLT general session on the 16th of March, which is next week. If you, March, got a month straight. If you want to join that, you're an Online Trading Academy XLT member, just check your calendar, type in Addiss, and you'll see everything he's got on the schedule going forward. If you are new and want to take bonds, go to tradingacademy.com to learn more. Done. Whew, tell you what. I think I'm gassed. That was a long-winded show today, but tons of great content. So, hope you guys enjoyed it. That's going to do it for me. I will see you mañana with Larry Jacobson. Have fun watching that 30-year bond auction. I know a lot of you have a piqued interest in it now. It is an important one. We'll talk about that on tomorrow's show. Take care, everybody. I'll see you tomorrow.